Hi there and welcome to the 2021 Coalition for a Prosperous America. What to expect the next 4 years. We have our currency panel. Moderating today is Marc Fasteau. Hi Marc, welcome.
What to expect the next 4 years.
We also have his guest.
Moderating today is Marc Fasteau. Hi Marc, welcome.
Thank you.
What to expect the next 4 years.
We also have his guest.
Moderating today is Marc Fasteau. Hi Marc, welcome.
Thank you.
What to expect the next 4 years. Also have his guest.
I think we've got a problem with the sound.
Yeah, I'm hearing that echo too.
Hey, Melissa? We've got a problem with the sound.
Yeah, I'm hearing that.
Hi guys, if you have two monitors on or you happen to have the live event and Hopin, we'll just have you close that out or mute it so that you're not getting that reverb from both sets.
The live event and Hopin, we'll just have you close that out or mute it so that you're not getting that reverb from both sets. Live event and Hopin, we'll just have you close that out so that you're not getting that reverb from both sets.
I don't think it's me, Melissa. I don't have Hopin open.
I just got my one laptop open. I don't think it's me either.
I don't think it's me, Melissa. I don't have Hopin open. And you don't have it open in a different window on your laptop, Mark, do you? You don't have it open in a different window on your do you?
So Marc, I do apologize. I believe that echoing is coming from yourself. If you want to go ahead and I'm going to unmute you and see.
Apologize. I believe that echoing is coming from yourself.
Do you have Hopin open on the background, Marc?
I'm going to unmute you and see. Apologize. Do you have Hopin open?
Off. It's completely off. The only thing open here is my computer.
Come a little bit closer to your computer then, Marc. See if that doesn't help. Do you have your audio on okay?
Yeah, so.
Come a little closer to your computer then.
How's that? Any better? No.
I do apologize for any of the technical difficulties that we are experiencing during this currency hour.
It doesn't seem to matter whether I mute myself or not.
Yeah, that's strange.
I can try to sign back in, but
Sure, we'll do that.
I could call up one of my IT experts from Revere to try and help.
We'll get him back on. He was having no problems earlier.
Should we start without him?
Let me see here. Here he comes. Let's give him a second try first.
Should we start without him?
Hi, Marc.
Hi, is that better?
Here he comes.
No, still echo.
No better.
Jeff, would you like to start with your presentation first, and then we'll bring in Mark afterwards, and he can just kind of pick right back up?
Okay, I'll do an introduction of everybody first. Should I do that?
Would you like to,
Melissa?
Yeah, why don't you go ahead and do that, Jeff?
And are we on now? Is the audience watching us?
They are.
And I still hear an echo. Where is that coming from? It's not coming from, is it coming from my system? Now it's gone, but now I can't speak, right? Oh, can you hear me? Okay, so good. So my sound is muted, but if we're on, I'll get going. Or Mark's here. Can Mark speak, or should I do it? So my sound is muted, but if we're on, okay, Brian, I'll take that as a go. Thanks. So welcome everybody to our currency panel. Sorry about the sound problems. The internet is unpredictable that way. We've got some innovative applications here, StreamYard and Hopin. So we're gonna go right ahead. Mark is gonna be a spectator for now. Just let me introduce the speakers. I'm Jeff Ferry. I'm the chief economist at CPA. Also speaking today, we have Brian O'Shaughnessy, who is the vice chairman of CPA and the chairman of Revere Copper. Following him, we'll have Joe Gagnon speaking. Joe is a senior fellow at Peterson Institute and has been writing on currency for many years and studying currencies. And finally, we're going to have Rob Scott, who is an expert on currency and industry at the EPI, the Economic Progress Institute, and has done some interesting studies recently too. Without further ado, I've brought some slides. I'm just going to hit some of the high points to update everybody on where the dollar is. So Melissa, thank you very much. If you could move on to slide 2, the next slide. The previous slide, please. What you'll see is that that's a graph of the dollar exchange rate in nominal terms. In other words, in the terms you read in the newspaper each day, and in real terms, that's the green line, and that's adjusted for inflation. And since the dollar bottomed in 2011, it has risen in nominal terms 30% as of the end of February. And so it's constantly gone up with some gyrations in there, but basically the dollar has continued to rise despite the fact that we've run trade deficits every single year throughout that period. By the way, economic theory holds that if you run a trade or a current account deficit, and I'm using the terms a little bit interchangeably here, if you run a deficit, your currency is supposed to fall until it erases that deficit and you're back in balance. Well, the US, as we know, has defied that rule or principle of economics for 45 years. We've run trade deficits, and on the whole, our currency has risen during that period. The real dollar is up just about 24% from the low point. And the importance of this is that an overvalued dollar handicaps US exports and gives importers an unfair advantage against US producers in the home market. So Melissa, if we could move on to slide 3, please. We've got a rule of thumb, one. Thank you. Rule of thumb in economics that every $1 billion on the trade deficit costs about 6,000 jobs. So if you do the math on our last year's trade deficit, which was $670 billion, if I remember correctly, this cost us about 4 million jobs. And by the way, I wanted to add, only this morning, the federal government came out with the current account deficit data for last year. That deficit jumped substantially up to $678 billion, or 3.1% of GDP. So the current account, like the trade deficit, looks very bad for us. And still, we've got an overvalued dollar. I said we've got we can roughly say 4 million jobs are lost due to that trade deficit. We believe at CPA, and many others in the economics fraternity believe, that the cause of overvaluation is persistent international capital inflows into dollar-denominated assets. And what we did at CPA was we built a model to try and estimate the effect of those capital inflows. I'm not going to go into that model in any depth. I just wanted to share one slide. So if you'd move on to the next slide, please, Melissa. You'll see that what the data published by the Treasury and the Fed show is that last year, capital inflows, actually 2019 capital inflow, no, I'm sorry, 2020, gross capital inflows reached $40 trillion. That's double the size of our GDP. And by capital inflows, just to be clear here, what we mean is foreigners or foreign corporations purchasing American assets, chiefly American stocks and bonds. And the data shows that of the securities they bought last year, 53% were Treasury bonds, 42% were U.S. equities, in other words, stocks. Equities continue to rise as a share of the total. The important point is that inflows are rising every single year. The data for 2021 so far shows we're on course for $50 trillion of inflows. This is well over double the size of our GDP. And this continues to rise, and continues to put buying pressure on the dollar and give an upward bias to U.S. currency. So that's in our view, the explanation. And some of my colleagues on this panel, I'm sure, are going to talk more about this phenomenon. What we did with our model was estimate what we would have to do to the dollar to balance trade and how that would impact the U.S. economy. So the next slide, please, Melissa, shows that the model that Steve Byers and I ran recently shows that a 26.4% adjustment in the dollar, decline in the dollar, would be necessary to put it to a trade balancing level.
Hey, you can let me back in. I figured out what it is. Okay.
And sorry, Mark, we heard you there. Okay, anyway, let me carry on. So we've got a 26, our estimate shows we need to devalue the dollar by 26% to achieve a trade balancing level. And if we move on to the next slide, I'd just very quickly like to hit two of the high points of our model. In this case, this is an update of a previous model, which you may have seen me discuss. We updated it with the latest data, and what we found is something very similar, that driving the dollar down by a total of 26%, in other words, over 4 years, driving it down linearly 6% a year, run through our REMI economic model, shows it adds roughly 1% to GDP each year. So at the end of the 4 years in 2026, we have GDP that's $1.6 trillion or 5.9% larger than it would have been in the baseline case. In other words, in the case of keeping the dollar at its current level throughout that period. So big, very large boost to GDP, to real goods and services sold and produced in the economy. If we move on to the next slide, please, Melissa, you'll see that we, of course, look at the job impact of that boost to the economy, and the total job impact is just under 4 million jobs. And because what we're doing is we're making the U.S. economy more competitive with foreign economies, the boost hits most strongly in the tradable goods sectors, which are manufacturing and natural resources. So we get 1.26 million additional jobs in manufacturing. That's over a 10% boost in the manufacturing sector alone. And that's a great thing for manufacturing. It's a great thing for every single sector of the economy when you deliver a boost by realigning the dollar, because the wonderful thing about a currency is it affects every sector, and that's very different from a targeted tariff or industrial policy or tax credit, which may have its own benefits, but tends to be focused on one narrow sector of the economy. Realigning the dollar can and should benefit the entire economy. Okay, so my last slide, I just wanted to mention, I thought it was appropriate to say that we've seen quite a lot of support for a competitive dollar. Of course, there's also opponents on Wall Street and elsewhere. We'll be talking about that. But among the supporters of a competitive dollar is Jared Bernstein, who is right now an advisor to President Biden. He said in a pithy article in the Washington Post a few years ago, dethroning King Dollar would be easier than people think. America could enforce rules to prevent other countries from accumulating too much of our currency. I'm going to leave it to my colleagues here to talk about what specific policies could achieve what Jared outlined there. I just want to quickly mention two other things. The IMF, it's common at CPA to denounce the IMF as some of those pointy-headed globalists on Pennsylvania Avenue. But in fact, they had a radical change of view in 2012. They saw what surges of capital inflows, particularly in Asia, were doing in the crisis of 1997, and they changed their view and published their view in 2012 to say regulating capital inflows and capital outflows can be an acceptable policy at certain times for national economies. Finally, Joe Gagnon, who's with us here today, said, and I'll quote him very quickly and leave him to talk about his own views in a few minutes, the main cause of the dollar is a secular overvaluation of the dollar caused by excessive financial flows into dollar assets from foreign officials and private investors. So we're thrilled to have an eminent representative of the Peterson Institute support and join us in a view that the dollar needs to be realigned. So those are my slides, just laying out the basic CPA position. I'm going to hand it over to Brian O'Shaughnessy, who's done international business for at least 30 years around the world. So Brian,
I'll reintroduce, I'll jump back in from the internet wilderness, found my way back in. So yes, Brian is next. And as he will tell you, he has experienced the firsthand the trials and tribulations of an overvalued dollar. And I think it'll be interesting to hear him tell us what he's had to endure and how he's coped with that. Brian.
Okay, thank you, Mark. I think Melissa has put up a few slides for us. Okay, Revere was founded. I think you can hit the button, Melissa, that opens the slide up so that you can see the whole thing. The topical one down on the bottom on the right. Yeah, there we go. Oh, you were on it. Yeah, there we go. Okay, so Revere was founded by Paul Revere in 1801, and you can see in this frame Paul Revere's picture here overlooking us, because we believe we're the oldest basic manufacturing company in the United States. Revere doesn't produce Revereware, as that subsidiary was sold to Corning 25 years ago. Revere produces, on the next slide, on the next slide too, Melissa, I'm moving ahead of you a little bit. One more. Thanks. Revere produces copper sheet, strip, coil. Our customers are primarily other manufacturing companies, mostly in the USA. Since the year 2000, over 30% of the facilities Revere ships product to in the USA have moved offshore. And in the next slide, I just want to mention, we believe we're one of the most efficient copper mills in the world. We visited many other mills throughout the world. Our principal domestic competitors in the USA have gone bankrupt or they've withdrawn from Revere's markets. So in the next slide, you'll see that in spite of our high productivity, we have difficulty competing in domestic markets. Although we have lower freight rates and quicker order response time because we're closer to the US customers that remain here. And we can't compete in foreign markets despite high levels of productivity because our price is too high. And the other problem is the foreign competition is driving the domestic price down. It restricts Revere's ability to make needed capital investments to maintain our high levels of productivity. I want to go on the next slide just to show you what the impact would be on a 25% realignment of the US dollar. And notice under Revere, an uncompetitive dollar and competitive, I'm having Revere's price would be in US dollars, let's say 40 cents. This is for the value added that we produce in the products we make. Now, if there was a 25% change in the value of the 40 cents, that would mean Germany in an uncompetitive market, they'd be undercutting us at 35 cents, but with a competitive dollar, their price would be 45 cents. And so in the next slide, you'll see that foreign competitors, what they will do, and because Revere's gone through this, they'll eat part of the difference in the exchange rate. So they won't raise their price from 35 to 45 cents. They'll raise their price to something like, in this example, we're saying 41 cents. And in the next slide, we're going to talk about the impact. What happens is that Revere will maintain our price. We won't change our price because we want to gain market share. The incremental cost of producing additional of our products is 50% of our base cost. So when we increase market share, that substantially increases revenues, and that'll generate our cash flow for investments. And so basically what I'm saying here is that as you see this slide, a 25% change in the realignment of the US dollar, we will not see a huge change in the price to consumers because American companies will try to regain the market share to fill their factories because factories in the United States are running on average about 80% capacity. And so we have lots of additional capacity we want to fill up before we even think about raising price. And the reason why I know that the German competitors will eat part of the change in the realignment is because that's what Revere's had to do over the years. As the dollar moved to negative, to levels that were very bad for Revere, we had to eat that change in the dollar exchange rate. So our German competitors and other competitors around the world will do the same thing. And so the price impact on consumers will not be what you expect, but it will have a major impact on our ability to compete in the rates and expand. In the final slide, the impact on Revere and domestic manufacturing, the oldest manufacturing company in the USA, we're talking about Revere here, will expand production and grow good-paying jobs. 20 years ago, we had twice as many jobs. We can get back to that. And the outsourcing of manufacturing jobs throughout the U.S. economy will reverse, and the highly efficient U.S. manufacturers who survived will go on the offense. And believe me, the U.S. manufacturers who have survived are really efficient and ready to go on the offense. Thank you.
Okay. Thanks, Brian. So, Joe, you're up next. Joe is a senior fellow at the Peterson Institute for International Economics. He previously served in several senior positions at the Fed, including most recently visiting associate director of the Division of Monetary Affairs, and before that in several positions at Treasury. He is a frequent contributor to economic journals and the co-author of Currency Conflict and Trade Policy and New Strategy for the United States. Joe has a PhD in economics from Stanford, and he is going to tell us why the US dollar is overvalued. Joe.
Thank you, Mark. And I was still hearing a bit of an echo there, so it might be best if Brian and Mark would temporarily mute themselves. Thank you. So, yes, what you just heard from Jeff and from Brian is that the dollar is and has been for some time now overvalued. I think of overvaluation is in terms of the trade balance. And there are reasons why some countries have surpluses and deficits, but it turns out for the US, we really overall, on average, over time, should have a zero balance. We should not have a surplus or a deficit. We've had a deficit for a long time. Even the International Monetary Fund agrees that that is excessive, that they think that we should be near zero. And when that's how I think of an overvalued dollar. If the trade balance has been in deficit and is expected to continue to be in deficit, not just a one-year blip, that's a sign of an overvalued dollar, as Jeff said. So as Jeff also said, the Bureau of Economic Analysis at the Commerce Department just today released what I think is the best measure of the trade deficit, which is the current account balance. As he said, that was a 3.1% deficit for the year, but in the last quarter of the year, it's 3.5%. And I think that it's going to be at least 3.5% this year going forward, which is a big increase over what it has been. All the more surprising considering that we used to import a lot of oil and we don't anymore. And normally countries that discover oil and stop importing oil see an improvement in their trade balance. We've seen a deterioration. So that makes it all the more surprising. Now, I've also just released today my latest working paper. You can see it on the Peterson Institute website, www.piie.com, where I look at trade balances across 138 countries over the past 30-some years, trying to explain them. This is the latest iteration of work I've been doing for almost a decade now. And we find that the two biggest reasons why countries have trade deficits are the fiscal policy and their exchange rate policy. And obviously, fiscal policy is an issue right now in the US. We're having a big expansion, so to some extent, we would expect a bigger trade deficit, but the trade deficit preceded the fiscal expansion by quite a bit, and it's going to continue long after. So I think we need to think about exchange rate policy. What are the major reasons in that score? Well, there are basically two issues in exchange rate policy. One is currency manipulation, which you have heard of. Currency manipulation appears to have taken a step up last year, a fairly big step up. Not quite back to where it was 10 years ago, but a big increase. A number of countries have been buying dollars. The governments have been buying dollars to prop up the dollar, to keep the dollar from falling. And notably, last year are Switzerland, Singapore, Taiwan, Thailand, and possibly Korea. In previous years, of course, China was the biggest manipulator, and it still is to some extent, but less than it was. Japan, Norway, and other countries. So I think given this resurgence of currency manipulation last year, which may continue in this year, I think the Biden administration needs to aggressively confront those countries. And I think the best way to do that, as I've said, and my former colleague Fred Bergson also said with me, is the United States should just counter manipulate. We can buy their currency. If they buy our currency, we can buy their currency. And frankly, it should be profitable for us to do that. But no one can challenge our ability to do that. And no one can borrow as much as the Treasury. No one can print money the way the Fed can. If we want to buy foreign currencies, there's nothing to stop us. That's what they do to us. If we do the same purchases in return, that should get rid of the dollar overvaluation and return trade towards balance. I think that's the urgent thing. Then the other thing, which is more longer term, I think, is how to deal with even if countries aren't excessively intervening and manipulating their currencies, they're still using the dollar as a reserve, and private investors seem to have excessive desires to invest in the United States. And then there's basically two tools. I think we should start a discussion with other countries in the IMF and bilaterally to try to get the US back on a more sustainable path of balanced trade. And the two tools, and I think Rob's going to talk about this next, but the two tools, as I see it, are our own foreign exchange intervention. Just more generally, we have almost no exchange reserves, unlike any other country. And they may be less important for us, but we still could have some. We could use a dollar policy that builds reserves and especially tries to counter excessive dollar valuations when they happen. This is a stabilizing policy. It's fully consistent with international obligations. And if that's not enough, and if we want more, we can also consider taxing these capital inflows that people are talking about. And that's the market access charge, which CPA has been promoting. And I think would be a useful additional tool to have to discourage these capital inflows that are keeping the dollar too high year in and year out. And I think I'll stop there, let Rob go on, then we can have more conversation. Mark, you're muted.
Thanks, Joe. Rob is next. He is Senior Economist and Director of Trade and Manufacturing Policy Research at EPI. His focus has been on the effects of trade and manufacturing policies on working people and on the macroeconomic effects of trade, capital flows, and exchange rates. Widely published, he has a PhD in economics from the University of California, Berkeley. So, Rob, you're going to talk about solutions, which Joe foreshadowed a little bit, but could you also add a little bit of detail on the private sector capital inflows that Joe referred to briefly? Bob, you're muted.
I don't know if that's
good.
Thank you. Pardon me. Thank you, Mark, for that introduction. I will briefly introduce the subject as well, set a little bit more context, and then talk about policy remedies and capital flows. I should mention at the outside, I work for the Economic Policy Institute. I think Jeff misstated it earlier. You can see our research at epi.org and find all of our papers there, including my own work on these issues. I focus on trade in particular because it's important to manufacturing and to the ability to sustain good jobs in the economy. If we rebalance trade, we can create millions of manufacturing jobs. I've come up with somewhat larger estimates than were mentioned earlier, but perhaps we'll talk about that more in the Q&A. But the main point I want to make is this. Manufacturing and also the construction sector, which are closely related, support good jobs for non-college educated workers. Both of those industries, I looked at this about a year ago in a snapshot I published. Both of those industries were paying, on average, workers were earning about $39 to $40 an hour, including benefits, whereas the services sector was paying much less, about $33 an hour. That's almost 20% less. And yet, if you look over the last 20 years, over the last 10 years since the Great Recession, almost all of the jobs created in the economy were low-wage jobs in the service sector, even lower-wage jobs in sectors like retail, trade, and restaurants, and healthcare. So rebuilding manufacturing and rebalancing trade are about creating good jobs, especially for non-college educated workers. So that is the point. And my institute does focus on policies that can help low and middle income workers. So to go to the causes, as Joe and Jeff and others have emphasized, the dollar has increased markedly in value. It's up about 25%, I think, now in real terms since about the 2014 period. And as Joe mentioned, that has two principal causes. There was extensive currency manipulation, especially in the 2000 to 2013 or so period that Joe and Fred Bergsten have documented in their excellent book on currency issues. And I think Joe refers to that as the decade of manipulation, if that's that, as I recall. And we've seen some resurgence. But recently, in the post-2014 period, there's been a massive surge in private capital inflows, private investors buying up U.S. stocks and bonds. And of course, economics tells us that any trade deficit has to be matched by an equal and offsetting capital inflow. net into the economy. And of course, if you look at these things in gross terms, as Jeff did in some of his slides, the gross inflows into stocks and bonds and foreign exchange are massively larger, equal to as much as 2 or 3 times the value of total GDP in our economy, upwards of $40 trillion over the last few years, $40 trillion or more a year of capital flowing into the U.S. Of course, most of that turns around and leaves a few days later. So what are the thoughts about how do we contain this? Well, as Joe said, one idea is when foreign governments are buying up dollars, they're doing it because they are motivated to suppress the value of their currency relative to the dollar. Or to be more accurate, they're trying to keep their currencies from rising. These are the countries like China and Japan and Korea that have large trade surpluses, plus a number of others. I think Joe has identified upwards of 20 countries that are have engaged in currency manipulation at some point. Those governments were buying dollars to keep the value of their currencies low. Why were their currencies tending to rise? Well, in part because there was a demand for their exports. And so the laws of supply and demand, if people wanted to buy Chinese goods or Japanese goods, that should push up the value of the currency. But those currencies did not rise because the governments intervened by buying the US dollar to keep its value high. So I think, as Joe said, one appropriate remedy is for the US to counterattack, to counter-intervene, or engage in what he calls countervailing currency intervention, or CCI, and have the U.S. Treasury and Federal Reserve buy up those foreign currencies, such as the Japanese yen or the Korean won, or the Chinese RMB. So that's one way to keep the value of the dollar low. But the other approach is to, in some way, disincentivize private investors from buying U.S. dollar assets, to make it simply less attractive. Well, how do we do that? Well, the simplest way to do it is to impose a tax on foreign purchases of U.S. assets. The two general ways to do this, Joe explains it quite well in a working paper he published in November. One is to impose a tax on new capital inflows. I believe Jeff Ferry has modeled this in a paper he published with Steve Byers. I think several papers, but one most recently I was looking at, I think came out last year. And they looked at the effects of a tax on new purchases of U.S. assets. So this is a tax not on U.S. investors, but on foreign purchases of U.S. stocks and bonds and government securities. And they modeled the effect of a 5% tax on foreign investors. So if a foreign investor wanted to buy $100 billion worth of U.S. stock, then they would have to pay a tax of 5% or $5 billion on that purchase. And so that would raise the cost of that purchase to them and reduce its value, and so reduce the incentive to invest in U.S. assets. Now, that's 5%, sounds like a big number. But Jeff and his colleagues ran that estimate through the models of the Federal Reserve, and they estimated that I think that this would raise interest rates in the U.S. by a very small amount, on the order of 0.3%. And you can comment on that, Jeff, if I got that wrong. But it have a minuscule effect on interest rates. To put that in context, in the last 3 months, in the first quarter of, which isn't quite done yet, of 2021, interest rates on longer-term U.S. government debt have increased by about 0.75 to 1 percentage point. So, frankly, the effect of the market access charge would be lost in the noise of the day-to-day variation in interest rates in the United States. So it's not going to have a significant effect on the cost of capital. What it would do is, as I think Jeff has estimated, it would drive the dollar down by about 25% over the next few years, and that would rebalance trade. I think it would be enough to eliminate the trade deficit, not just overall, but in manufactured products, which is what's driving the loss of manufacturing jobs. And to go back to where I started, the United States has lost 5 million manufacturing jobs over the last 20 years. The loss of those jobs is responsible for the devastation, especially of the industrial heartlands, the upper Midwest, but also the Northeast and the south parts of the U.S. They have suffered enormously. And this has been especially harmful to, again, non-college educated workers. And they have reacted with anger, frankly, at both political parties. And that's why it's so important that, to me, it's one of the reasons why it's so important that we address these issues, both to deliver good jobs to these workers and to rebuild the economy. Now, I forgot to, and I'll just close by talking about the other ways we can attack this issue. As I mentioned, we can impose this tax on foreign purchases of U.S. assets. That's called the market access charge, a concept that was developed by an economist, John Hanson, former World Bank economist. He's been working in this for a decade or more. He was involved with many of us here in developing a bill that was recently introduced in the last Congress by Senator Tammy Baldwin, along with Senator Josh Hawley. And it was a bipartisan bill. And that bill would have both authorized the Treasury and the Federal Reserve to impose a market access charge. And it would also have increased lending authority for the Federal Reserve to engage in the countervailing currency intervention that Joe has described. So that bill would have implemented both of the tools that we've talked about here. There are other ways to bring down the dollar, which I think are of similar nature. One is to impose a tax on the income of foreign investors, or a foreign income tax. I call that an FIT. We have these abbreviations. We have the MAC for the market access charge. We have the FIT for the foreign income tax, and the CCI for coordinated currency intervention. These are the tools we talk about in these discussions. But I think to keep the concept simple, we're talking about a tax on foreign capital or public purchases of foreign assets. Those are the main tools. There is a third category of remedy, and that is the idea of allowing the U.S. government to impose sanctions on countries that manipulate their currencies. And this was recently authorized by the Trump administration. And I think last year, the Commerce Department imposed duties for the first time against Vietnam in a case involving exports of, I think, steel products from that country. Right. So that's a third general class of alternatives, but it's a small bore remedy. It sends a message, but it's not nearly as effective as the other tools we've discussed here. So with that, I think I'll stop and turn it back to Mark.
Well, thanks, Rob. A couple of questions that people frequently raise about the market access charge. We call it the MAC. First is, would that end the dominant role of the U.S. dollar as the world's reserve currency? And if it would, what would follow? And do we care? Does it matter? Anybody who wants to can answer that.
Maybe let me take a stab. Okay, so there is no obvious competitor to the dollar right now. So I just don't see how this would. I mean, we're talking about a modest charge here. We're not talking about closing down our capital markets. We're just saying, look, if you guys, foreign investors, excessively want to have U.S. assets relative to other people. We would like to just put a modest tax, just to make you think maybe you could invest somewhere else. Not to say you can't invest here, but just to try to, at the margin, incentivize you to go elsewhere to a reasonable extent without shutting down our markets. I just can't believe that is going to be lethal to the dollar. But even if it is, I guess the obvious, there's either renminbi or the euro would be the two obvious choices. I just don't believe that they would take over. But if they did, it isn't. I mean, the fact that euro is number 2 now is not really hurting Europe in any way that I can see. The advantages of being the reserve currency used to be said, the only one that ever made sense was it gives us lower interest rates. And that's true, but not by a lot. And, interest rates are not too high, and they're far from being too high. So it's hard for me to see serious risk here, even if it did dethrone the dollar, which I don't think it would.
So you can see multiple reserve currencies as the most likely output over time, but not probably the RMB until, if ever, they decide to loosen up on their capital controls. Yeah,
which they are doing slowly, and over time, depending. Look, how China interfits with the rest of the world is a huge issue beyond the scope of this session.
right.
But if they were to behave well, play nicely in the world, and continue opening up their markets, sure, the renminbi would get a growing share. They've said they want that, and I can see a multi-currency world as not being harmful.
Okay, so for Jeff, how much money? Recognize it's a moving target because the tax the MAC would reduce the inflow and thus reduce the revenue. But I think you've done some estimates on how much revenue would be produced and over what period. And given the very large infrastructure bills that are working their way through the administration and the Congress, some of that money might be pretty useful, even if it can't be relied on as a continuous stream. But what have you found out?
Right. So, Mark, in our model, what we found, as Rob said, was that a 5% MAC would induce the dollar to realign to a competitive level, and it would also cut inflows by something on the order of 25 to 30%. So we still got large levels of inflows into dollar-based assets, and that would generate $670 billion a year of cash for the Treasury or for the U.S. taxpayer. Now, what we added to that was that we don't think in the real world a 5% MAC would be required. We think that the U.S. government simply saying, look, we're focused on moving the dollar to a competitive level would have such an impact on the psychology of the financial markets that it might be that only a 2% MAC would be required to achieve the same result that you get in the model with 5. So we think a good estimate of the annual revenue from the MAC is $300 billion to $600 billion a year. And as you say, that makes a lot of sense to think of that in terms of aligning with an infrastructure program, because at that rate, in 5 years, you can generate a couple of $2 trillion, which would pay for a very healthy infrastructure program. And part of the reason why it makes sense to think of it that way is this is not permanent money. If you keep the MAC in place, you're going to move the U.S. to balanced trade, and you're going to hold it there. And after that point, you're not going to get nearly as much revenue from the MAC as you do in the first several years. So you can think of it as a huge inflow to the Treasury and to the taxpayer for 5 years or so, thereafter a much smaller inflow. So the lesson is it could pay for a total Biden infrastructure program and keep the government budget deficit at whatever level it's at now, or maybe even reduce it a little.
And that's all revenue from non-U.S. entities and citizens, correct?
Right. That's sort of the genius of it, is that nobody in Congress wants to vote for tax increase for anybody who can vote. Well, foreigners don't vote. We're talking about taxing all those hedge funds in the Cayman Islands and those Chinese bankers and all those people who should pay something for the privilege of holding U.S. financial assets.
Great.
And if I could just
Wow.
circle around and add one comment to something Joe said
Sure.
about the trade-off between being a reserve currency or not. If you look at there's a great book called The Rise and Fall of Great Powers by a Yale professor, Paul Kennedy, who said the effort of being a superpower always requires a flourishing economy behind it. And in a sense, that's the trade-off we're being offered. Do we want to have a very strong, overvalued currency and be the world's financial leader and have a struggling economy inside our borders? Or do we want to have a flourishing economy at home and a competitive currency? And I think that's the latter choice we have to go with.
Yeah, absolutely. Right on. We have to get rid of the use of the term strong currency. Strong currency, weak economy. I mean, we have to use the word, socialize the word competitive currency as the right descriptor. Ryan, you had something you want to say?
Yeah, I'm just thinking that as Jeff mentioned, the inflows to the U.S. to the federal government in terms of the monetary benefits of a MAC, while that would taper off, at the same time, the results of the MAC would cause employment and manufacturing to reverse and to start climbing. And as Rob Scott was saying, those loss of 5 million jobs, the percentage loss in our economy of manufacturing jobs actually mirrors Revere's loss very well. And so I think that there would be, in my opinion, a 25% increase in manufacturing jobs at least. And this would occur over time. And so that as you see the income from the MAC tapering down, the benefits of having a stronger economy and generating more tax revenues because of that, and less unemployment benefits and costs and subsidies like that, would cause a major ongoing effect to the revenues of the U.S. government if we were to succeed in realigning the currency and doing it with a MAC.
Well said. That's very well said. So, however good an idea the MAC or the FIT are, they would require legislation. They would, at least the MAC and maybe the FIT would alter and add a mandate to the feds, adding a third mandate. That's going to take a while, even under the best political alignment. What about using the International Economic Emergency Powers Act to set up the market access charge by executive order? Does that work? Can it be done? Is there any precedent? How has that act been used in the past that might be relevant?
I can take an introductory shot at
Rob,
that.
you're on mute.
Pardon me? There it is. I am not. Melissa,
No,
perhaps.
Go for it.
Okay. Thank you. I appreciate it. And Joe may have a point to add on this, but there is precedent. The last two times we had major dollar realignment, they were preceded by executive or congressional action. The first time was in 1971 when the United States began the process of getting off of the gold standard, the Bretton Woods system that existed since the Second World War, because of the beginning of large, trade deficits, and at that time, current account deficits, and capital outflows. And so Richard Nixon at the time announced that he was closing the convertibility of dollars into gold, and he imposed a temporary import surcharge and said he would leave it in place until the major G5 governments agreed to raise the value of their currencies against the dollar. And he said he would leave it in place. This took place in September of 71. I think by December of that year, they had come to an agreement, international agreement, to negotiate currency realignments. And in fact, over the next 2 or 3 years, we transitioned to the modern system of flexible floating exchange rates that has worked out not very well for the U.S., frankly. It was an incomplete system, I think, in my view. Then again, in 85, we did something slightly different. Congress threatened to impose tariffs, similar remedy, twice. They passed a bill in the House, and that led to an agreement known as the Plaza Accord, where, again, the U.S. and at the time, I think the G7 countries got together and agreed to a major currency realignment against the dollar. So Congress or the executive can use executive or legislative power to bring about temporary currency realignment. What we're proposing to do here with the MAC or the FIT is to bring about a permanent system for maintaining a balanced dollar and balanced trade flows. We need to having ongoing management, and that's I think the beauty of the MAC proposal is charging the Federal Reserve with adjusting that market access charge on an ongoing basis so as to keep the dollar within a trade balancing range. So that's the concept. But you're right, it would be tough to get Congress to pass that. We've got to do a lot of education to get there. But in the meanwhile, I came up with a set of proposals that I outlined in November of last year that the Biden administration could use to begin to implement these kinds of proposals. They could, for example, impose taxes on foreign holdings of U.S. government assets. Currently, foreign governments, China, Korea, Japan, don't pay taxes on their interest income as a result of treaty arrangements they have. We can suspend those treaties on 6 months' notice and begin to collect taxes. And this is something that Joe and one of his colleagues, Gary Huffpower, talked about a decade ago. So I'll turn to him for that discussion. But that is an option the president possesses, and Treasury and the president can do that. And that could begin to reduce demand for the dollar. I'll stop there.
Joe, anything to add?
Well, yeah, I think what Rob said sounds right to me. I would only just say that the IEPA, International Emergency Economic Powers Act, gives the president wide scope to do just about anything he wants on the international sphere in terms of U.S. transactions with foreigners. So I believe that some of the Trump tariffs were justified on the basis of that law. And I think it just comes down to, is this an emergency or not? Well, were aluminum imports an emergency or not? Trump said they were an emergency, so we got them. Do we think the trade deficit overall, writ large, is an emergency? Well, I would have a hard time personally saying it's an emergency, but in a sense it is, because we've borrowed our net debt to foreigners is 68% of GDP, which is an enormous amount. And although it's a slow motion emergency, it may be considered, you could make, so yes.
Yeah. Okay. Well, one more question. I'll make the statement, then see what you guys think. Is the overvaluation of the dollar the largest single obstacle to ending the trade deficit, to bringing back manufacturing, to the success of the Biden Build Back Better program? There are clearly many other factors some of which have been talked about on other panels, but where does this stand in that hierarchy, in that unpleasant hierarchy? Ryan.
Well, in my opinion, yes, because it impacts the entire value of the product. You could do things like taxes on profits, but profits are a percentage of your income. We're talking here about the total revenue stream of a manufacturing company being impacted. And so, yes, as I look to compete in global markets, That's the biggest factor that Revere faces.
Rob?
I have to be a two-handed economist here a bit. I think, yes, the dollar is the overvaluation of the dollar is the single largest cause of the U.S. goods trade deficit and overall trade deficit. So I think on that score, yes, rebuilding manufacturing, getting a dollar right is the single biggest step. I think in terms of the Biden plan, especially the forthcoming rebuild program for infrastructure and climate, those are domestic objectives. They'll have a huge impact on these issues, and getting the dollar right will make them even more effective, but those are domestic objectives. So I think we have to keep them separate.
Joe? Jeff?
I agree with Rob. What Rob said has been right. The dollar is the fundamental reason for the persistent U.S. trade deficit. I mean, economic cycles cause it to move back and forth, up and down, but the reason on average it's in deficit is the dollar.
Well, that's a good way to close. Thank you all very much. I think this has been enlightening, and I hope our listeners and viewers enjoyed it. Melissa? You're on mute.
Thank you guys very much for joining us today. I do appreciate it. I would love to have you guys all back on for another collaborative discussion. I think that this was a really powerhouse, a whole entire panel of bringing you five gentlemen together and talking about currency. There's so much more that we can discuss on this issue, and it's nice to see that we've got some really great leaders that are making the headway for this. So thank you all very much. We are going to start going into the closing of our ceremony for day one. I do appreciate all of you taking the time out. If you're viewing this on our CPA attendance event platform, stay tuned. We will bring you Zach models soon. Thank you, guys.
Thank you.